My name is Louisa, and thank you for joining this Employment Taxes on-demand session on the taxation of company vehicles. Company vehicles are a common employee benefit, but they also come with complex tax and national insurance implications. Whether it's a company car, a van, or even a shared pool vehicle, how it's used and how it's reported can significantly impact both employers and employees from a tax perspective. Today, we'll be breaking down in this topic into the following sections, starting with what we mean by availability when we talk about benefits in kind and why it matters, how to calculate the cash equivalent of a company car, how to determine the list price and apply the relevant CO2 percentage, and the fuel scale charge and how it's calculated. We'll also cover benefits in kind for company vans, the benefit associated with van fuel, any exemptions for van fuel and mileage, the recent changes to tax treatment of double cab pickups, and finally, the special rules that apply to pool cars and vans. By the end of this session, you should feel much more confident in navigating company vehicle benefits and their tax treatment. Just a couple of quick notes before we begin. When I refer to employees, this does include directors, as they often have a company vehicle at their disposal. And during this session, I will be using rates from the 2025-26 tax year, and these are subject to change, and so I recommend always checking the current rates when carrying out any calculations. Before we dive into the technical content, it's important to understand why this session matters and why it's worth paying close attention. When it comes to tax compliance, HMRC applies two main types of penalties. The first is an unprompted penalty, where you disclose an issue to HMRC before they find it, usually resulting in lower penalties. The second is a prompted penalty, where HMRC identifies the issue themselves, which can lead to penalties of up to 100% of the unpaid tax. And this is more than just theory. We've seen real cases where organisations have been hit with six-figure penalty bills, particularly for incorrect or missing reporting of company cars, vans, pool vehicles, and fuel benefits. Company vehicles are a common area of risk. For example, some common risk areas include incorrectly calculating the cash equivalent of a company car, treating vehicles as pool cars when they don't meet the criteria, and failing to correctly classify company vans that are used privately. These errors not only create unexpected tax and national insurance liabilities, they also open the door to public scrutiny, as HMRC can name and shame non-compliant employers. That can seriously affect your organisation's reputation with clients, investors, and staff. So while some of today's topics may seem a bit technical, understanding and applying them correctly is crucial for avoiding costly mistakes and protecting your organisation's credibility. Let's start by talking about availability, one of the more easily misunderstood aspects of company vehicle taxation. The taxable benefit isn't determined by how often the vehicle is actually used, but rather by whether it's available to the employee for private use. This means that even if the employee only drives it occasionally or not at all in a particular month, the benefit still applies as long as the car is at their disposal. So, what exactly do we mean when we say available? Essentially, if the car is parked at the employee's home or they can access it at any time for private journeys, then it's considered available. However, there are situations where a vehicle might be unavailable. For instance, if it's undergoing extensive repairs or has been taken back by the employer. In these cases, the taxable benefit can be reduced for the period when the vehicle wasn't available. Just make sure there is evidence to support this, such as service records or documentation showing the vehicle was returned. If we are calculating the cash equivalent and we have periods of unavailability, then all we need to do is multiply the cash equivalent by the number of months it was available divided by 12 months. It's a subtle distinction, but really important when determining the correct taxable benefit. Now we understand the concept of availability, let's dive in to calculating the cash equivalent of a company car, which is the taxable value of the company vehicle benefit. This is an essential concept because it's the amount that will be used to determine the tax liability for the employee and the Class 1A national insurance contributions due from the employer. To calculate this, we need to follow a simple method. We start with the vehicle's list price. This is the manufacturer's suggested price and should include all optional extras. So if an employee has upgraded their vehicle with extras like leather seats, alloy wheels, or a premium sound system, make sure to add these to the total list price. Next, you multiply the list price by the relevant percentage. This percentage is based on the vehicle's CO2 emissions, so the more carbon dioxide the vehicle emits, the higher the percentage, and therefore the higher the taxable benefit. This is designed to encourage the use of low-emission vehicles, and we will cover this carbon dioxide percentage in a few moments. Finally, you need to consider any capital contributions. If the employee makes contributions for the vehicle, this can be deducted from the taxable amount, lowering the value of the benefit. By following these steps, you'll have the correct cash equivalent to report for tax purposes. It's important to get this calculation right, as it directly affects how much tax is owed by the employee and national insurance by the employer. Now that we've seen how to calculate the cash equivalent of a company car, there's an important rule that we need to cover, and that's optional remuneration arrangements, or OPRA. OPRA applies when an employee takes a company car through a salary sacrifice as part of a flexible benefit arrangement. If the employee chooses to take a cash allowance instead of the car, that allowance is treated as regular earnings and will be subject to tax and national insurance through payroll. Since 2017, HMRC has required employees to compare two figures when OPRA is in play: the normal car benefit calculated using list price and CO2 emissions, and the amount of salary given up. Whichever is higher becomes the taxable benefit. That means OPRA often results in a larger tax charge for the employee and a higher Class 1A national insurance for the employer. There is one key exemption: low-emission cars. If a vehicle emits 75 grams of CO2 or less per kilometre, then the normal benefit rules apply, even if salary sacrifice is used. This is part of the government's efforts to encourage greener vehicles. So, if your employees are receiving company cars through salary sacrifice, or choosing between cash and a car, it's crucial to assess both figures. The OPRA rules mean that you can't just rely on the standard benefit calculation. And from an admin point of view, make sure that the amount given up is clearly documented and that payroll and benefit systems are aligned. This is one of those areas HMRC will pay close attention to in the event of a review. So we've previously discussed the list price of a vehicle, which includes any optional extras on the car and including VAT. Let's now explore in more detail the relevant percentage that we apply the list price by to get the cash equivalent. So, what determines the relative percentage? There are two main factors. The first is the vehicle's CO2 emissions, and the second is its fuel type, whether it be petrol, diesel, hybrid, or electric. The UK government sets out published bands that assign percentage rates depending on how much CO2 the car emits. These are updated every tax year, and so it's essential to check the latest version when doing your calculations. Generally speaking, the higher the emission, the higher the percentage. That means that vehicles with bigger engines or poor fuel efficiency will result in a larger taxable benefit for the employee. There is also the diesel supplement to be aware of. If the vehicle is diesel and doesn't meet the RDE2 emission standard, an additional 4% is added to the percentage, although the total percentage is capped at 37%. So for example, a petrol car emitting 120 grams per kilometre of CO2 might fall into the 30% band, but a non-RDE2 diesel with the same emissions could end up at 34%. On the other hand, electric and low-emission vehicles are taxed far more lightly. A fully electric vehicle is taxed at just 3% of its list price in 2025-26. This electric car percentage is set to increase by 1% each year for the upcoming years. Some hybrids with very low emissions and good electric ranges can also fall into lower bands. This is part of the government's push to promote more sustainable vehicle choices and it makes a noticeable difference when calculating the cash equivalent value. So, now that we've covered how the relevant percentage is based on the car's CO2 emissions and its fuel type, let's have a look at the actual rates for the 2025-26 tax year. On this slide, you can see how the percentages increase with emissions. For electric vehicles, they're currently taxed at just 3% of the list price, which is significantly lower than petrol and diesel vehicles and designed to incentivise greener travel choices. Hybrid vehicles, meanwhile, have their own specific treatment. Their percentage rate depends on two things: their CO2 emissions and their electric-only driving range. The further a hybrid can travel purely on electricity, the lower the percentage it will fall into. For example, a plug-in hybrid with a low CO2 figure and electric range of over 130 miles can qualify for the lowest benefit in kind bands, whereas one with a shorter range will be taxed more heavily. But this is key. These low rates aren't fixed forever. This graph shows how the benefit in kind percentages are set to increase across a range of vehicle types over the next few years. And that's not just electric vehicles. You'll see that the rate for fully electric vehicles, currently at 3%, will rise by 1 percentage point each year, reaching 7% in 2028-29. But it's not just electric vehicles. Other emission bands are increasing too. For example, cars emitting 51 to 54 grams per kilometre will also see incremental rises. Vehicles in the 100 to 104 grams per kilometre band will remain at 26% until they increase to 27% in 2028-29, and higher emission vehicles like those emitting over 170 grams per kilometre will remain the same, then increase to 38% in 2028-29. These changes are part of a broader push to tighten emission incentives and gradually reduce the tax gap between low and high emission vehicles. So while electric and low emission vehicles still carry a tax advantage, these planned increases should be factored into any long-term planning, especially when it comes to fleet management, vehicle choices, or salary sacrifice arrangements. Now that we understand how the relevant percentage works, let's pull it all together with a practical example. We're going to compare 3 different vehicles, all with the same list price of £30,000, but each will have a different fuel type and emission level. This will show just how much of an impact the relevant percentage has on each of the cash equivalents, and therefore both the taxable benefit for the employee and the national insurance cost to the employer. Let's start with the petrol vehicle. This car emits 120 grams per kilometre of carbon dioxide. Based on the current HMRC 2025-26 rates, that puts it in the 30% band. So the cash equivalent is calculated like this. £30,000 multiplied by 30% gives us £9,000. That £9,000 becomes the taxable value for the employee for that year. For the employer, there's also the Class 1A national insurance cost, which is currently charged at 15% in 2025-26. So £9,000 multiplied by 15% gives us a national insurance bill of £1,350. Now compare that to a diesel vehicle that does not meet RDE2 standards. It also emits 120 grams per kilometre, but because of the diesel supplement, the relevant percentage increases to 34%. This means that the cash equivalent is £30,000 times 34%, giving us £10,200. Again, that's the taxable benefit for the employee. For the employer, the national insurance is £10,200 times by 15%, which comes out to be £1,530. That's £180 more in national insurance than the petrol vehicle, and an extra £1,200 in the taxable benefit. Finally, let's look at the fully electric vehicle. With zero emissions, the relevant percentage is just 3%, so we calculate 30,000 multiplied by 3%, which gives us a cash equivalent of £900. For For the national insurance, it's 900 times 15, which will be £135. So that's a huge difference and clearly shows how electric vehicles are incentivised through lower tax rates. By using the same list price across all three, you can see how CO2 emissions and fuel type directly impact not just how much tax the employee pays, but also the Class 1A national insurance cost to the business. It's a powerful example to keep in mind when advising on company car policies or choosing vehicles for your fleet. Now, let's move on to a related but separate element of company car taxation, the fuel scale charge. This applies when an employer provides petrol or diesel for private use in a company car. It's important to note that this is treated as a separate benefit in kind from the car itself. Also, if the vehicle is electric, there will be no fuel scale charge for providing electricity, as this is not seen as a fuel, so the charge does not apply. So, what is the fuel scale charge? It's a taxable benefit that reflects the value of the fuel the employee receives for personal journeys, like going to the shops, visiting friends, or taking a weekend trip. Even if the employee only uses a small amount of fuel privately, if the employer pays for any private fuel and it's not fully reimbursed, the full fuel benefit applies. So how is it calculated? HMRC publishes a fixed figure every tax year, and in 2025-26, this is £28,200. To calculate the benefit, multiply that figure by the car's relevant percentage, just like you would for the vehicle's cash equivalent. So if a car has a relevant percentage of 30%, the fuel benefit is £28,200 times 30% to give us £8,460. That full amount becomes the taxable benefit, regardless of how much fuel was actually used. There will also be an employer Class 1A charge based on the cash equivalent, so that would be our £8,460 times 15% to get £1,269 to be paid by the employer. There's no partial credit for contributions. Even if the employee pays back some of the private fuel cost, it doesn't reduce the taxable benefit. To avoid the fuel scale charge entirely, the employee must reimburse the full cost of the fuel provided, and this must be done by the 6th of July following the end of the tax year. So, to summarise, any fuel for private use equals a separate taxable benefit. This is calculated using a set figure multiplied by the vehicle's relevant percentage. And any partial reimbursements does not reduce the charge. It must be fully repaid to avoid it. It's a good idea to keep clear records of reimbursements if you're trying to avoid triggering the fuel scale charge. Now let's take a look at how company vans are taxed, which is different from cars. First, let's clarify what HMRC classifies as a van for tax purposes. HMRC defines a van as a mechanically propelled vehicle that is primarily constructed to carry goods or burden, not people. The classification is based on the vehicle's design, not how it's used. This means that if the vehicle has side windows or extra seating behind the front row, it's unlikely to be considered a van and may be treated as a car instead. When an employee has a van available for private use, it triggers a benefit in kind, but unlike cars, the tax treatment is different. For vans, the cash equivalent is not based on emissions or list price. Instead, HMRC uses a flat rate approach. For the 2025-26 tax year, HMRC has set a flat benefit value of £4,020 for a van available for private use. This flat figure becomes the taxable benefit, even if the private use is just occasional. There's no need for percentage calculations like with cars, it's just that fixed amount. However, there are a couple of important adjustments to be aware of. The first is van unavailability. If the van is unavailable for 30 consecutive days or more, the benefit can be prorated, reducing the taxable benefit for that period. And then there's business-only use. If the van is used only for business travel and any private use is insignificant, for example, a quick stop at the shops on the way home, there is no taxable benefit. But just to note that weekend trips or using it for school runs would not count as insignificant private use. Now for zero-emission vans, the P11D reporting is treated slightly differently. From the 2020-21 tax year, zero-emission vans are reported on the P11D at 0% of the standard benefit value, which is £4,020. This means that the taxable benefit is £0 for zero emission vans, effectively resulting in no taxable benefit for the employee. This change makes the process a lot simpler as vans are treated similarly from a tax perspective, regardless of fuel type. So in summary, vans are taxed using a flat rate benefit in kind system with a standard rate of £40,020 per year. The benefit can be adjusted for unavailability or business only use, and zero emission vans are reported on the P11D at 0% of £4,020, resulting in zero as the taxable benefit in kind amount. This makes the treatment of vans much more straightforward compared to cars, but you still need to ensure proper reporting, especially for zero emission vehicles. Now let's turn to van fuel. The treatment here is similar to company cars. If an employer provides fuel for private use, a fuel benefit arises, and that triggers a separate taxable charge. For the 2025-26 tax year, the van fuel benefit is set at £769 per year. This is a flat rate charge, there's no percentage to apply, and no adjustment based on emissions. This benefit is also subject to Class 1A national insurance to be paid by the employer where private use is provided. But here is the key point, which is similar to our treatment of car fuel. If the employee reimburses the full cost of private fuel, the fuel benefit can be avoided entirely. It's all or nothing. Even partial reimbursements don't reduce this benefit. So for employers and employees alike, keeping a detailed mileage log and full fuel records is essential. In summary, van use is exempt from tax if it's limited to business travel or commuting, with only minor personal use. But if private fuel is provided and not fully reimbursed, the £769 flat rate charge applies, and that needs to be included in benefit reporting. Not all van use results in a taxable benefit. In fact, there are a couple of key exemptions worth knowing, and the first is around mileage. If a van is made available to an employee for only business journeys, there's no taxable benefit. Even if it's used for commuting or there's occasional incidental private uses, such as stopping at the shop during a business trip, it can still be exempt, as long as private use is considered insignificant. The threshold here is about pattern of use. If an employee regularly uses the van for school runs, weekend trips, or anything beyond incidental journeys, the exemption is no longer valid, and the flat rate van benefit would apply. That's why it's important to carry out regular checks to confirm that use remains compliant and to keep written evidence, just in case HMRC ever asks. It would be best practice to conduct regular checks on any van use and maintain clear documentation such as mileage logs. This makes sure you apply the exemption correctly and are protected in the event of a HMRC review. Let's now talk about double cab pickups and some important changes that came into effect on the 6th of April 2025. A double cab pickup is a vehicle with 4 doors, 2 rows of seats, and a separate load area at the back, essentially combining the features of a passenger car with those of a goods vehicle. These have historically been popular in company fleets because they offered practicality and were treated as vans for tax purposes, provided they had a payload of at least 1 tonne. Up until now, HMRC allowed most double cab pickups meeting that 1 tonne payload threshold to be taxed as vans. This meant that a flat rate benefit in kind, generally much lower than the car benefit charge, and simpler reporting requirements for employers. However, HMRC have reviewed this treatment and concluded that most double cab pickups are equally suited to carry goods and passengers. Because of the tax test that focuses on primary construction of the vehicle and not how it's used, these vehicles will no longer meet the definition of a van under tax rules. As a result, from the 6th of April 2025, most double cab pickups have been reclassified and taxed as cars for benefit in kind purposes. That means the benefit will be calculated based on the list price of the vehicle and its CO2 emissions, which could result in a significantly higher tax charge for employees and increased employer national insurance costs. That said, HMRC has introduced transitional relief. A double cab pickup that was already used or ordered or leased before the 6th of April 2025 it can continue to be treated as a van for benefit in kind purposes until the earlier of the vehicle's disposal, the end of the lease, or the 5th of April 2029. In short, this is a significant shift in how double cab pickups are treated for employment tax purposes, and it's important for employers and employees to be aware of the change. It could have a substantial impact on fleet planning, benefit costs, and payroll reporting going forward. Now let's take a look at pool cars and pool vans, which are treated differently for tax purposes and often exempt from benefit in kind charges when strict conditions are met. A pool vehicle is essentially a car or a van that is shared amongst employees, it's used only for business purposes, and it's not allocated to any one individual. These vehicles can be a valuable resource for organisations, but it's important to understand the rules to qualify for exemptions from tax. To be exempt from benefit in kind tax, a pool car or van must meet all of the following conditions. The first is that the vehicle is available to more than one employee and is not used exclusively by one person. The second is that it's only used for business journeys, and any private use must be purely incidental. For example, driving the vehicle to a nearby cafe during a business trip may be incidental, but commuting to and from home would not qualify. And finally, the vehicle is not normally kept overnight at or near the home of any employee. Instead, it should be stored on company premises outside of working hours. It's absolutely vital that records are maintained to support this exemption, and this will include things like mileage logs, booking systems showing shared use, and records that demonstrate the vehicles aren't being kept at home or used privately. Without clear documentation, HMRC may argue that a benefit in kind has arisen, even if private use was unintentional or limited. So, to summarise, pool cars and vans can be exempt from tax, but only if strict criteria are followed. The key is to limit use strictly to business, ensure the vehicle is genuinely shared, and to keep strong records to prove it. Before we wrap up, let's quickly recap the key points we've covered in this session on the taxation of company vehicles. We started with the concept of availability and how the taxable benefit is linked to whether the vehicle is at the employee's disposal for private use. We explored the cash equivalent, how it's calculated using the list price of the vehicle and its relative percentage based on its carbon dioxide emissions. Next, we looked in more detail at the list price and the relevant percentage, including how emissions and fuel type drive the benefit in kind value, and how low emission vehicles are incentivised through lower tax rates. We have also discussed the fuel scale charge, which applies when fuel is provided for private use, and how it's calculated using HMRC's set figures. From there, we moved on to vans, outlining the flat rate benefit in kind calculation, explaining the rules for exemptions when vans are used only for business or commuting. We covered mileage and fuel exemptions, where private use must remain insignificant and full fuel reimbursements is needed to avoid any sort of charge. We then discussed the recent changes in tax treatment of double cab pickups and the transitional arrangements that have been put in place. And finally, we examined the rules around pool cars and vans, including the strict conditions for exemptions from tax and the importance of documentation to support that status. Understanding these principles is essential for ensuring accurate and compliant tax reporting, whether you're advising employees, completing P11Ds, or updating internal policies. So thank you so much for taking the time to join me today. I hope you found this session helpful, and please, if you have any questions or need any sort of further clarification on anything we've covered, please feel free to reach out via email at employmenttaxesteam@unw.co.uk. Thank you so much and enjoy the rest of your day.